So credit conditions are tightening. You've heard this many times. Federal Reserve also said credit conditions will continue to tighten, and that's also equivalent to a 25 basis point rate hike. Now, when I say, and when they say, actually not me, but when the Fed says credit conditions are tightening, it actually means they're worsening. Things are getting worse in the economy when it comes to credit. And credit is very important. Credit's the life, the blood of the economy. Without credit, without loan, without debt, the economy wouldn't work perfectly. You would not be interested in the stock market. Stock market wouldn't be going up. Real estate prices, etc., etc. The whole economy runs on credit and loans. Now, before I get into this article here, my name is Daniel. I run an organization called etfs. Etfs is an organization that promotes financial literacy, teaches you about macroeconomics, and ties it in with the financial markets. Now, if you want to learn and know more about this content, and feel free to subscribe, hit the like button, bell icon to be notified on the next video, and you'll see more content about this information, or just like this information. Now, going back to this article, it says U.S. bank deposit outflows continue, small bank loans collapse. This comes out from Zero Hedge. It says yesterday's continued surge of inflows into money market funds increased usage of the Fed's bank bailout facility set the scene for the ugly data from last week's NSA deposits to accelerate. A lot of money is flowing, and people are starting to realize keeping your money at the bank in those deposits are much more riskier, and might as well pull them out, because the threshold of what the banks are willing to insure you on is around, I believe in the US, 250,000. Anything below 250,000. Now, if you've got money more than 250,000, then you're not insured on that. And if the bank goes bust, then guess what? Yeah, your money is gone. And a lot of wealthy people, or people who have more than $250,000 in their account, are realizing it's time to move that money into money market funds, because at least there you'll earn a good yield, and also you run the risk of, you avoid the risk of having a bank failure and losing your money completely. At least with money market funds, you could be fully guaranteed that your money would get back. You would get it back. Now, with this that's happening, it's also causing problems for these banks, for many of the banks out there, especially the regional banks. And why the regional banks is because, well, before all of this issue happened, the regional banks were very favorable to a lot of these high net worth clients who needed the rules to be bent in order to get a certain loan, because they weren't getting it from the traditional banks, right? The regional banks, the smaller banks are out there to help people. The idea is to help people who are unable to get a loan or credit from the traditional bank, and help them out in order, if it comes to buying a house or whatever the needs are. That's the idea of the smaller banks, to fill that gap. Now, we're seeing with the less scrutiny in the regulations as how the big banks have, we're seeing a problem with these regional banks and them imploding because, yes, they mismanaged the funds. Some of them weren't really hedged well. And on top of that, you're having massive outflows at record levels. Now, going back to this article, it says, according to the latest H8 report, the Fed on a seasonally adjusted basis, total U.S. commercial bank deposits fell $13.8 billion during the week ended, the second straight week. And it also says, however, the seasonally adjusted basis U.S. commercial bank deposit, ex large time deposits, decreased $25.4 billion last week after rising $10.92 billion the week before. That is the lowest since March 2021. And going down also, it says Judging yesterday's money market inflows, the deposit outflows continued this week. Remember, deposit data is lagged by a week. And it also says in this article here that before we move on, it is a key note that there are literally massive revisions to all of these time series this week, with around 100 billion in deposits removed from small banks, adjusted up to the large banks, right? You're seeing the money flow to the large banks as there's less trust with the smaller banks. But that is creating a problem, because on the other side of the ledger, you have commercial bank lending tumbling to 15.7 billion in the week ended May 3rd, increasing 41.9 billion the prior week, according to seasonally adjusted data. Small bank loans fell 13.6 billion. So you get the idea. It's basically getting ugly. And it's getting ugly because deposits are being taken out. If deposits are being taken out, there's less opportunities for these regional banks to provide credit. And if there's less opportunities there, and there's a cascade effect, a contagion effect, then the larger banks, well, JP Morgan coming out, trying to buy the pieces, pick up the pieces. And also, there's fears in the markets. And when fears happen, panic happens. And when panics happens, you see really the economy and the markets really deteriorate really fast. Now, with these deposits going out, these outflows very quickly, it also contracts credit, which is the lifeblood of the economy. Banks out there become very risk averse. They don't want to lend easily. Regional banks don't want to lend easily. Even the big banks would look at their situation and say, okay, we also want to be careful because of what's happening. We don't want to give loans too easily. We don't want any panic, because if the panic cascades into their business as well, and if they overlent, it will be a very bad situation. So this is where you could see banks going to certain consumers or businesses and saying, hey, you have that line of credit there, we're going to take some back. You've got a 10K, 50K line of credit, we're going to take some back because we're worried of what's to come. And they're not going to tell you that, but they're going to say that, hey, you're not using it that much, so we're going to take it back. And that might be somebody's emergency funds. And then if that's somebody's emergency funds and a situation like the recession worsens off and that business needs those funds but are unable to, and the banks are unable to give any money, guess what these businesses do? They lay off workers. And a lot of the people who are employed in the US, they're employed by small, medium businesses. If they start to lay off workers, the unemployment rate skyrockets, businesses are under trouble, consumers lose, people lose their job, consumer spending drops, and you could see the cascade effect, and the economy really takes a nosedive. Same with the market, same with the stock market and the equities out there. So again, watch the credit, watch the credit conditions, the outflows of money, the deposits, the money moving into the money markets and whatnot. Watch the credit, because the credit's the lifeblood. And Jerome Powell, the head of the US Federal Reserve, he didn't just come out of the blue saying that credit conditions are going to tighten and it's going to cause more pain for the sake of just saying it. He said it for a reason, because he sees what's coming down in the economy. He sees issues in the economy and credit conditions worsening off, where it could lead to a cascading effect in that recession, that hard landing. Anyways, let me know what you guys think. Leave a comment below, subscribe, hit the like button, bell icon to be notified on the next video, and I'll see you guys around. Cheers, bye.